Hey friends, I'm back today with a really timely and important message. You're seeing it all over the news. In fact, I've had over a dozen text messages just in the last week asking what's going on in the mortgage industry with these upside down mortgage policies that are going to favor the lesser qualified, taking from the more well qualified. I'm going to dive deep into that. But this whole thing over the last week reminds me of a couple of situations, and I know I'm sure you can relate. Have you ever encountered a situation that just made absolutely zero sense? So we were at a restaurant up in Stanwood. It was kind of the tail end of the COVID period. The maximum people that they could seat at a table was 8. Well, we had 9 people. And so we were like, well, let's just do this. Let's get a table for 4. And then across, we'll do the table for 5. There's 2 tables over there. We'll do 4 at one, 5 at the other. No, we can't do that. We can only do 8 at one time. I'm like, all right, so let's all go outside of the restaurant. Let's not come in together and let's ask for a table for 5 and a table for 4. Would that work? And she said, yeah, that would work. This mortgage policy that Fannie Mae is adjusting May 1st, 2023, is very similar to that. Or like when you go to the airport and you check in luggage and it has 54 pounds in it and the max is 50. You got to take 4 pounds out and put it in your backpack. Real similar. It's still going on the same airplane. So again, makes zero sense. Let's dive into this because I want you to understand this. This is what I do for a living, and it really irks me. It bugs me when things happen in our industries, both real estate and mortgage, when the consumers come to me and they're confused. And I don't like that. So what I'm going to try to do is make sure that you're not confused. I'm going to try to make sense of a policy that it's rolling out in a week that really makes absolutely zero sense to mortgage people. But I promise you, by the end of this, in 5 minutes, you'll have complete clarity around this. I put together a 5 slides, a 5-slide presentation that's really going to help you understand what this means, but not only just what it means. I think it's going to be what it means to you, how it will impact you, if it will at all. And also, let me talk about this real quickly. This presentation is mainly geared toward real estate agents so that you can teach your clients, mortgage professionals, so you can have better conversations with realtors and your clients around these policies. If you're a consumer, if you're a homeowner, if you're a home buyer, I'm going to send this out to you and you're going to get this. You'll understand it, but understand I'm going to be teaching this more from a professional standpoint. So let's do this real quick. I am going to, I think I only have like 5 slides here. This is going to be super simple for you. So bear with me while I pull this up. And the other thing is, if you have any questions on this, I want you to reach out to me. This is something that I don't think there's going to be a million questions on this, I believe. And it's not, I don't want to go too deep in this presentation. So I'm going to ask you if you have questions on this, or if you want me to run a scenario, reach out to me, direct message me, email me. I'm happy to get back to you. So yes, Fannie Mae is revising their loan level pricing adjustments May 1st, 2023. You have to understand, first and foremost, Fannie Mae does this often. They just did this in January for second homes and investment homes. They do this to help protect us. So I will start out by saying this. They do this to help protect us as lenders and you as homeowners, the housing market, the housing industry. This policy might not make a whole lot of sense relative to that, but that's why they do that. That's why they adjust, they make adjustments, and they're constantly doing this. So I want to take a couple of, there's 4 real big articles that have been sent to me. One by the New York Post. The title of this is How the U.S. is Subsidizing High-Risk Homebuyers at the Cost of Those with Good Credit. The New York Post is completely accurate on this. I just think the headlines position it in a way that probably is going to create a lot more negative attention to this versus the positive. I like to look for the positive. The next one that I had a client of mine, a realtor client of mine, very credible local realtor, sent me this from the Washington Times. Again, a fairly credible news organization. Biden to hike payments for good credit home buyers to subsidize high-risk mortgages. Another one that I had sent to me the other day, Fox News. Biden rule will redistribute high-risk loan costs to homeowners with good credit. Okay. Another one, and this was, I just pulled this one off of Instagram, new mortgage fee structure, 620 FICO score gets a 1.75 fee discount, whereas a 740 FICO score pays a 1% fee. Yes and no. Yes, that's accurate, but that's not, you can't take that at face value. And you're going to see this in a chart. Now, the Wall Street Journal the other day came out and their headline was upside down mortgage policy. Reliable borrowers will subsidize high risk borrowers. I actually like that heading the most from the Wall Street Journal. Upside down mortgage policy, reliable borrowers will subsidize riskier borrowers. So let me show you what that means. But in order to understand this, you have to really be crystal clear on what an LLPA or a loan level pricing adjustment really is. Loan level pricing adjustments are risk-based fee adjustments to borrowers using conventional mortgages only. The majority of mortgages, 5% down, 10%, 20%, 30% down mortgages are backed by Fannie Mae and Freddie Mac, and those are conventional mortgages. Loan level pricing adjustments vary from borrower to borrower based off of credit, down payment, type of property, debt to income ratio, and type of mortgage, fixed versus adjustable rate. So you have to understand these news organizations are not going next level deep like I am right now, saying what are loan level pricing adjustments? What adjustments? The only adjustments they're talking about are the down payment and the credit score. There are many other adjustments that have been hit too. Again, to protect us in the mortgage industry, our industry, and you as a homeowner to protect the housing market from crashing, okay? So they have tightened up some lending practices there, some lending guidelines there. Number 3, loan level pricing adjustments are set by Fannie Mae, not your bank and your lender, okay? So I, at New American Funding, or New American Funding is not raising their rates. This is Fannie Mae is raising the cost of their mortgages that we get from them, okay? So they are set by Fannie Mae, not your bank or your lender, and they increase the cost of your mortgage, your rate or your fee based on certain risk factors. Different types of properties, condos versus single family homes, multifamily homes, so investment homes versus owner occupied homes, down payment, 3% down versus 30% down, stuff like that. Now they've added debt to income ratio to the mix. We'll talk about that here in a minute, but I think it's really important to understand realtors, lenders, home buyers, homeowners, these things that we're talking about, these LLPAs that we're going to be talking about today, the stuff you're seeing in the media is only for Fannie Mae backed or conventional mortgages, not jumbo, not FHA, not VA, and not USDA home loans. It's important to know that. Okay, so now that you understand what loan level pricing adjustments is, and then down in the comments, I'm going to put both of, and if you're getting this via email, I'll have this attached. If you're seeing this on social media, I'll have this grid down in the comments. So where you see it brightest red or brightest orange, that's the area that has been most affected by these changes. Now, and this is what's catching the news. Look at this area, 80 to 85% loan to value, so less than 20% down, 760. So here's credit scores, you guys. 760 credit score, 740 credit score, 720 credit score. So these are the majority of home buyers out there right now. They're putting down anywhere between 5 and 15%. And so, yes, so these news articles where they're saying, hey, they're going to subsidize, U.S. is subsidizing high-risk buyers at the cost of those with good credit, Biden to hike payments for good credit home buyers. Look at this grid. They're absolutely right in their headlines. What I like to focus on, though, is look at all this green. These are areas where people can put less money down and actually get not a discount, but a discount on the loan level pricing adjustments. So the loan level pricing adjustments went down in those areas. Loan level pricing adjustments went up slightly in these areas, the more well-qualified borrowers. One of the ways I like to look at this in trying to say somewhat neutral, let's say in the United States of America, you make $200,000 a year. You are taxed differently than someone that makes $100,000 a year. Let's say you make $500,000 a year or $1 million a year, you're taxed differently. So sure, you're in a higher tax bracket, you pay higher taxes. I think that the government is kind of looking at this going, we need to provide first-time home buyers in certain demographics a little bit more help. They're getting beat up by high interest rates right now. They're getting beat up by high home values. So a certain part of the population that we really want to help, the population that needs a little help, we're going to make conventional mortgages just a little bit more affordable for them to possibly help them out. The people that don't really need help, yes, there's going to be a little increase in the cost for those mortgages. Now we're talking about on a $600,000 mortgage, I'll break this down in a minute, maybe $3,000 in closing costs, which is a lot. I'm not downplaying that by any means, or maybe an eighth of a point in your interest rate. Okay, so let's talk about this. Do people with bad credit get a better deal than people with good credit? They get a better deal relative to the loan level pricing adjustment. They don't get a better deal relative to rate. So someone with a 660 credit score and 5% down is not getting a better interest rate than someone with a 740 credit score and 20% down. That's what I wish the news articles would have addressed. They're getting less loan level pricing adjustments by having that lower credit score and that lower down payment. Okay. The penalty or the cost for having a credit score under 680 is now smaller than it was prior. That's what the message I want you to hear. And borrowers with higher credit scores will be paying slightly more than the base cost for that rate or that fee, the fee associated with that rate. Let's talk about this. So what I did is I really circled in, I targeted the hot, if you're looking at a heat map here, the hottest area on this map is anywhere between 15% down and 20% down. Okay. So, and let's look at 740 to 760, 740 to 760, and 720 to 740 credit scores. These guys right here are going to have a slight increase in their LLPAs. So what does that mean? Let's look at it real quick. So a 740 credit score with 10% down on a $600,000 loan amount. Okay. The old LLPA was a 0.25 charge. The new LLPA is a 0.75 charge. That's a difference of 0.50, which on a $600,000 loan is about a $3,000 increase in your closing costs. That's a lot of money. I'm not downplaying this. I don't like that. It is a lot of money. Let's look at another one. 740 credit score with 5% down instead of 10%. So 5% down. The old LLPA was 0.25. The new is 0.625. So it's a 0.375 charge difference in charge, which is about $2,200 in cost. So it's a little bit less for the people that are putting a little bit less down. I think you can see, and that's even at a 740 credit score. But get this, a 780 FICO score gets that scenario back to the old LLPAs. So reading between the lines here, Fannie Mae, Freddie Mac, the government is saying, hey, 740 used to be an A+ credit rating. We're gonna add two more tiers, 760 and 780. So now 780 is considered A+ credit. Okay. The average credit score in America is about 715 right now. I think you can fact check me on that. So 740 still seems like a great credit score. Well, the way that Fannie Mae is looking at it for mortgages now is 780 is going to be a great credit score. I'm going to put this in the comments below, and I'm going to attach it as well so you can see this. So I want to focus on a couple of different areas, 3 things on this that I think you really need to know. The old LLPAs versus the new. The first thing is look at this. Fannie Mae has added 2 new tiers for credit score. Again, the old LLPAs, if you had a 740 credit score, you got the best of the best. Now that 740 is 3 tiers down. Okay. So 760 has their own tier now, and now 780 or greater has their own tier. So big takeaway from this. This is a big takeaway. Dial in your credit score. Understand how to ace your credit score. If you want more information on this, I've got numerous videos on the top 5 ways to have an 800 credit score. It's really simple. I can walk you through that. So the second thing I want you to see right here, let's say you have bad credit, like a 680 or lower credit score. If you put down 30% or more, you have 0 loan level pricing adjustments. Look at the old ones. Even if you put 30% down, you still had loan level pricing adjustments. So for even if you have bad credit but you have 30% down or more, hey, we're going to help you out here. So part of this is why it's upside down. This is why anything government doesn't make sense. They're adding new tiers of credit score for lesser down. If you have 780 credit score, you're considered an A+ borrower. We want to encourage better credit scores. On the flip side, let's say you have a bad credit score. If you put more money down, like 30% down or more, we don't care, and we're going to help you out there. Okay, so that's the second thing. The third thing, look at this tier over here. This tier over here, over in the bottom right, is for your people that are putting 5% down or less. Look at the differences between this tier down here and this tier, the old one up here. So if you're putting 5% down or less and you have poor credit score, you're actually getting a break. That's where none of this makes sense. Less down, lesser credit score, lesser loan level pricing adjustments. Remember, loan level pricing adjustments are to account for risk. So this is the part where some of these articles where they're saying well qualified are going to subsidize the lesser qualified. This is the part of it for me, kind of like checking at the airport. And they're like, Mr. Keller, we need you to take out 3 pounds out of your bag and put it in your backpack. Yeah, your bag's going to be traveling on the same airplane as your backpack and you, but you just can't have it in the suitcase. This is the part of it that doesn't make a whole lot of sense for me. But let's focus on, and out here, let me show you this real quick, and then we'll focus on the closing comments, which is the positive. So a 660 credit score with 5% down, $600,000 loan amount, the old, you would be hit with 2.25 loan level pricing adjustments. The new, only 1.625. So now that's a savings for lesser qualified of almost $4,000. That's good. Again, their mission is to help the lesser qualified get into homes. I don't want to say the lesser qualified, underprivileged maybe, or people that are struggling in regards to price points, in regards to maybe rebuilding their credit scores. Okay, they're providing some incentives there, maybe a little bit lower cost to facilitate or promote home ownership. All right, another one, a 640 credit score with 10% down is 0.625% more expensive than putting 5% down. That's part of this, like I showed you in that previous matrix, that doesn't make sense. 640 credit score and you have 10% down is more expensive than if that same person put 5% down. So who you work with matters. That particular client, here's the hack. That particular client, I would look at their scenario. I understand these matrix. That's why I teach them. And I would say, hey, Mr. and Mrs. Smith, I'm going to have you put 5% down. You're going to get a better credit score, or excuse me, you're going to get a better interest rate and closing costs by only putting 5% down. I know you have 10. Your PMI might be a little bit higher, but what we're going to do is we're going to do something called a recast. You're going to make a payment, and after your first payment, you're going to bring that additional 5% down. We're going to take it to our servicing department. We're going to recast your loan. We're going to remove private mortgage insurance. And guess what? You got the best of both worlds. Now you have a lower loan amount, lower payment, better private mortgage insurance, and you got the best LLPA. So the bottom line is make sure that you're working with a pro. Key takeaways. Fannie Mae's goal with this is to encourage home ownership to the lesser qualified and underserved areas, underserved people, and communities. It's been a bloodbath for the last 4 years. I get what Fannie Mae is trying to do. I think they have a ton of confidence, I think, behind the scenes in that 720 to 740 borrower. They have confidence in them. They also know that they have the money. Okay. They also want to encourage you to go from 740 being A+ now to 780 by adding that tier. Think of this. You want the best rate, get your credit scores up over 780. I can help you with that. The other thing is put down more than 20%. Used to be the standard 20%. Now it's 25% or 30% to get that best rate. If you don't have these twos, you got to make sure those two things. You got to make sure you're working with a pro like us. All right, I want to close with this. So debt to income ratio, this has never been a factor. Debt to income ratio is now going to come into play, and it will impact your interest rate. So if your debt to income ratio is over 40%, which many are, and you're putting down less than 40%, which many are, then you're going to be paying a 0.50 additional cost on your mortgage. $600,000 loan, that's $3,000 just because you have a higher debt ratio. It's also, you're going to see loan level pricing adjustments increase for 2 to 4 unit properties. You're also going to see loan level pricing adjustments increase for cash out refinances, but today is all about purchases. So it's important to know that these loan level pricing adjustments, number one, they don't come out of pocket. These are already set by Fannie Mae. So when you come to a mortgage company, the rates you're getting from us, the fees that you're getting from us, they're already included. All right. So it's just the standard pricing that you're going to get at a bank or a credit union or someone with me has just increased a little, along with high interest rates out there anyway. So understanding that debt to income ratio is going to be a factor. I want to spend one moment on this. A lot of times people will shop for a mortgage online because it's easy, and they shop rate. Rate is important. Do not get me wrong in regards to getting a competitive interest rate out there. But I think who you work with matters most. We have very competitive interest rates. I've never had a problem with our interest rates compared to a bank or a credit union or a mortgage broker here in town. Okay. Who you work with matters most, because the advice you get right now in this market, high interest rates, low interest rates on the horizon, changing loan level pricing adjustments, escalation clauses, waiving contingencies because of the competitiveness in the market. If you're working with a pro, you're protected. If you're working with a bank or a credit union or someone that's sitting in a skyscraper in Ohio, they're not out here in the Seattle area to be able to understand the markets and to be able to be flexible and agile enough in the markets to help you when you need it most. So please understand this with debt to income ratio. If you're comparing interest rates online with other people, this is not getting included in their marketed rates. This is something that will be added to once you apply and you take full application. So in order to get an accurate rate quote now, which I like, you've got to take a full application for a home loan. Okay, so there's a couple of programs in addition to Jumbo, FHA, and VA that are exempt from this. Number one, the Fannie Mae Home Ready, and number two, the Freddie Mac Home Possible. Now, these are loan programs that allow for 3% down, and they are in areas where there is an AMI, area median income, where they allow up to 100% of the area, the AMI. Now, in the Seattle area, it's really difficult because of the price of homes. So I'm not going to spend a whole lot of time talking about this, but I'll put links in the chat so you can click on those. If you're looking for a home in a certain area and you make under the designated AMI, there's an opportunity to qualify for a couple of these programs, and they help you. I have not seen these being used a lot because the prices of homes going up so much. People just don't qualify under that 100% AMI because the price of homes, but it's worth noting. All right. We're going to leave with this in summary. Credit score and credit improvement is key. Okay. Remember, these are not additional fees that you pay in addition to, they're already worked into your loan from Fannie Mae. We as lenders get those. Utilizing seller credits in this market is huge if you can get those. Those are 2-1 buy down, permanent buy downs. These are ways to lower the interest rate or get the seller to pay for some of these costs that we're absorbing. This is normal. Like I opened up today, you guys, Fannie Mae adjusts their loan level pricing adjustments often. They did it back in January. They did it a year or two ago as well. They do this often. This is nothing new. Lastly, working with a mortgage pro, not a box checker, is more important than ever. I want you to reach out to me if you have any questions. I hope this was helpful. It was a little longer than I'd liked, but I think that in the end, you guys, a lot is happening out there. It's very important that, again, the media is designed to get clicks. But if you want accurate information, just reach out to me. That's what I'm here for. Okay. Bye for now. We'll see you on the other side. If you have any questions, I am here to help.